Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the OPEC meeting, the US non-farm payrolls unemployment report, China foreign reserves, and how it relates to the Chinese yuan. Before that, I'll run down the biggest events in the economic calendar. On Monday, there's manufacturing PMIs from China, Europe, the UK, and the US. On Tuesday, it's the Reserve Bank of Australia rate decision, UK construction PMI, and API oil inventories. On Wednesday, it's services PMIs from China, Europe, the UK, and the US, and the Bank of Canada rate decision. On Thursday, it's US ADP unemployment. Then on Friday, it's China foreign reserves, Eurozone GDP, and US non-farm payrolls. And there's also China inflation data due out on Sunday. Moving on to the top corporate results to watch this week, slowing down a little bit because we're coming to the end of the major reporting season, but nonetheless, Ford Motor report third quarter earnings on Monday. Barnes & Noble and Hewlett-Packard Enterprise report Q3 earnings on Tuesday. Stagecoach reports a half-year update on Wednesday. Kroger, who recently inked that deal with Ocado, and Sears, which has just entered bankruptcy, report third quarter results on Thursday. And then Berkeley Group offers its half-year numbers, and Big Lots report Q3 earnings on Friday. So attention very much on this upcoming OPEC meeting. That's of course because oil prices have absolutely crashed going into it. We just saw WTI tick below $50 per barrel. We really see that as the market testing OPEC here. We were promised supply cuts from OPEC and its partners, namely Russia. But really what's happened is Saudi Arabia especially have pumped out massive, if not record amounts of oil. And that was in anticipation of these Iran sanctions, which ended up being a little bit watered down. So the market has massively readjusted, down from $75 down to below 60 for Brent. So it's been a huge drop. What we've been saying since 2016, and I think this is being borne out in this latest price crash, is that the oil price will be cyclical. Basically, US production will follow the price, and it's US production which is the marginal producer now, not OPEC. So obviously OPEC can affect it at the margins. If OPEC does cut its supply, that will have an immediate effect. I think what we're looking at is default expectations of 1 to 1.5 million barrels per day being cut. That being the consensus and the market's still dropping, I think OPEC need to probably surprise on the upside here in terms of the amount they're going to cut to actually try and stabilize this market. Obviously, the big data release every month is non-farm payrolls. So it's critical timing, particularly after those dovish comments from the Fed's Jay Powell last week. So as a quick refresher, he said, quite importantly, that he sees the neutral rate, sees current rates just below the neutral rate. So a rate at which interest rates are probably about right for the US economy. So the implications being there that the Fed is ready to slow down its rate hike cycle in 2019. Obviously, that's a dovish thing for the dollar. So, what does that mean for markets? It's generally a pretty dovish thing for the dollar. That's why we saw the dollar pull back quite dramatically, the euro bounce, gold bounce off their lows last week. And we think probably that does continue. And as far as stock markets, well, the good economy, which again we'll be looking at as far as non-farm payrolls, do we see a good jobs number? Do we see wages rise? A good economy plus a dovish Fed, that's the kind of Goldilocks scenario that the stock market loves. So that could set us up quite nicely as we enter December this week for that Christmas Santa rally. Then the last thing we're just looking at this week are the FX reserves released by China. That's particularly important as the renminbi or yuan approaches this important 7 level. So basically what we're trying to assess here is how much the PBOC has been defending that 7 level. If these results show that there was a lot of defense, so the People's Bank of China had to chuck a lot of money at keeping the yuan strong above that 7 level against the dollar, then it's a bad sign for the Chinese economy. It shows desperation that they want to stem the outflows. And so what that probably means is that it eventually sets up some sort of speculator versus central bank standoff, with this 7 level being key. If we don't see any much sign of defense, which actually has been the case more recently, then the USD CNH pair that's traded with LCG, that could drop, but may probably drift through that 7 level eventually without that defense in place. Well, thank you very much for watching. Good luck for trading this week. And if you want to see these videos as soon as they are released, please follow LCG on YouTube and social media.